if I knew what the market was going to do, obviously, but you don't. I don't think anybody knows what the market's going to do. I think you do know whether you're making an intelligent purchase at a given price.
Most of us feel like we're just guessing when it comes to the stock market. Stocks are high, the headlines are all over the place, and it's hard to shake the feeling that things could turn at any moment. But here's the best part, even the experts are divided. But one person seems to have a clear plan, Warren Buffett. Known for his almost uncanny market foresight, Buffett's been making some bold moves by doing almost nothing. He's sitting on billions in cash, $270 billion to be exact, holding back instead of jumping into new investments, which he's only done before. Let me count every major market crash of the last 30 or 40 years or so. So what does he know that we don't? Today, I'm breaking down why he's sitting on billions in cash while everyone else is all in. What is his hidden pattern? One he's followed before every big market drops. I'll break down the signals he's watching, what this means for the market, and most importantly, how you can use his strategy to stay ready for anything. Let's take a trip down memory lane to see what Buffett's been up to in the past when years in the market started to look a little shaky. Warren Buffett doesn't react like most investors. In fact, he's made a career out of staying calm when everyone else is scrambling. But here's the fascinating part. Right before some of the biggest market crashes, he started making subtle moves that, in hindsight, was pretty genius. Let's start with one of his best examples, all the way back in the late 1960s and early 80s. High inflation, rising interest rates, and an economy that, on paper, looked like it was growing just fine. But for regular investors, those years were a nightmare. The stock market barely made sense, and once you factored in inflation, people were losing money just by holding on to stocks. But while everyone else was riding that roller coaster, Buffett was doing something different. He wasn't dumping stocks altogether, but he wasn't pouring his cash into the market either. Instead, he held back, watching for the right moment to make a move. And sure enough, when prices fell, he was ready with cash on hand to buy up valuable assets at bargain prices. Fast forward to the late 90s, right around the time of the dot-com bubble. This was another period when Buffett chose to stand back and avoid the frenzy. Tech stocks were soaring. Everyone was going all in on anything remotely tech-related. But Buffett didn't buy into the hype. Instead, he stayed invested in industries that he understood. Things like insurance, railroads, consumer goods. People thought he was out of touch, missing out on the future. But when the bubble burst, he was one of the few who came out stronger, proving once again that sometimes the best move is no move at all. And of course, there's 2008. Just before the housing bubble financial crisis hit, Buffett started increasing his cash reserves again, stepping away from sectors that were riding dangerously high. When the crash hit, he was in a prime position to buy assets for pennies on the dollar. That's the thing about Buffett's strategy. It's not about timing the market perfectly, but being ready. He builds up his reserves, waits, and then he buys when prices hit rock bottom. Each time, he ends up way ahead. And these examples aren't just random blips. They're a part of a pattern that shows Buffett's tendency to be extra cautious right before a big market drop. It's as if he can see the storm clouds gathering while everyone else is soaking up the sunshine. He doesn't predict exact crashes or market dips. Instead, he focuses on making sure that he's in a strong position if things do go south. And looking at how often that's paid off, it's hard not to wonder if there's something to this approach. Alright, so we've seen how Buffett tends to play it cool before things get rocky. But let's talk about what he's been doing lately, namely holding on to a lot of cash. Now, I'm not just talking a little extra on the side. Buffett has been stacking up billions, which is basically his way of saying, I'm ready if things go south. And if history has taught us anything, it's that Buffett does not keep this kind of cash reserve for no reason. Here's how it works. Investors file these things called 13F filings every single quarter, which shows where they're putting their money. When we look at Buffett's recent filings, something stands out. He's not piling into stocks like everyone else. Instead, he's holding on to record cash levels. It's the highest amount of cash he's held, well, since before some of the biggest market downturns ever. So why does Buffett love cash so much, especially now? Cash gives him the freedom. When you're sitting on that much cash, you're not pressured to sell off your investments during a downturn. In fact, cash lets you do the opposite. You get to buy assets at a steep discount when everyone else is trying to get out. This strategy isn't just about sitting back and waiting for a sell, though. It's about flexibility. And for someone like him, that patience has paid off more times than we can count. Now, this whole cash pile strategy is not just a theory. It's something we've seen in action. Take 2008, for example. Buffett kept a lot of cash on hand right before the crash, and when everything was at rock bottom prices, he jumped in. He was able to buy valuable assets for a fraction of their worth because he didn't have to sell anything during the panic. He had the freedom to buy more when the prices were at their lowest, and that move alone led to massive gains once the market recovered. But here's the part that's relevant to us. Buffett's cash reserves today are on par with those levels we saw before previous market drops. He's clearly holding back, watching the current economic landscape. Interest rates are up, inflation is high, and tech stocks are getting explosive again. All things have been historically signaling caution. So what does this mean for everyday investors like us? We've covered Buffett's history and why he loves his cash cushion, but here's the part that's really intriguing. Are we seeing the same signals today that Buffett saw before those past market downturns? Because if we are, that could mean big things for what's ahead and how you should be thinking about your own investments. Let's start by looking at today's financial landscape. We're dealing with high inflation, rising interest rates, and a market that's been unusually hot, especially in certain sectors. Sound familiar? Well, these are all conditions that we've seen during previous times of weak returns and heightened market risk. Buffett has seen it too, and as usual, he's playing it safe, holding off on big investments and keeping a record amount of cash, saying, "Hey, I've seen this movie before, and I know how it ends." But what about those exact signals he seems to be watching? For one, the current price-to-earnings ratio in the stock market is hitting levels similar to the dot-com bubble. Matter of fact, it has crossed that multiple times. Back then, companies were wildly overvalued, with prices that had little to do with actual business fundamentals. Today, tech stocks in particular are getting pricey again. And while that doesn't automatically mean a crash is coming, it is enough to make any investor cautious. Buffett himself has trimmed most of his holdings in these high-flying sectors, which is a subtle way of signaling that he's not convinced the prices are worth it right now. Then there's the matter of interest rates. We're seeing them climb back up, and historically, high interest rates have been one of Buffett's indicators for staying cautious. Why? Because when you can get a decent return for something as stable as government bonds, stocks have to offer a much higher potential return to be worth the risk. When rates rise, investors tend to be more selective about where they put their money, which can slow down stock market growth. Let's not forget corporate profits, another important piece of Buffett's puzzle. Right now, corporate profits are high, possibly higher than they should be considering the challenges many companies are facing with costs and supply chain issues. If those profits start to shrink, it could bring stock prices down with them. Buffett, as usual, is keeping his cash handy, waiting to see if this overvaluation starts to unravel. And of course, if it does, he'll be ready to swoop in and buy assets at a discount, just like he's done in the past. So how can we look at this as regular investors? Think of it as a series of signals, a hidden pattern if you will. Buffett doesn't scream crash from the rooftops, but his actions tell a story. Rising PE ratios, high interest rates, inflated corporate profits, these are red flags he's noticed before, and he's reacting by holding off, keeping his options open, and stacking cash. If that doesn't make you want to pay closer attention, I don't know what will. So what does this mean for you and me? Sure, none of us have the Warren Buffett level of cash reserve, but that doesn't mean we can't learn a thing or two from his approach. Buffett's strategy isn't about predicting exact moves, it's about being prepared for what comes our way. And right now, his move suggests he's all about playing it safe. So let's look into a few key specifics that can help us do the same. First up, let's talk about cash. Now, I know the idea of holding on to cash isn't exactly exciting, especially when everyone else seems to be making quick gains in the stock market. But here's the thing. Having some cash on hand isn't about missing out. It's about giving yourself options. Think of cash as your opportunity fund, and when the market dips, and history shows that it eventually will, you've got the flexibility to buy great investments at bargain prices. You don't need Buffett's billions for this. Even a small reserve can make a difference. Another key takeaway is patience. Buffett doesn't jump into trendy sectors just because they're hot. In fact, he's famous for sticking with companies and industries that he understands, even if that means missing out on the latest hype. So if you're feeling the pressure to dive into the newest tech stocks or whatever's buzzing on Wall Street, take a breath. Ask yourself if this investment really fits with your long-term plan. Now let's talk about value over trend. One of Buffett's core strategies is to focus on the value of a company rather than its price. Trends come and go, but a company with solid fundamentals, strong earnings, a loyal customer base, good leadership, they're more likely to weather those ups and downs of the market. So, if you're eyeing a stock because it's the next big thing, maybe take a step back and look at the bigger picture. Is this a company that will still be around in 10 or 20 years? Or is it just the flavor of the month? And finally, let's face it, timing the market is a trap. Even Buffett, with all his experience, doesn't try to time every peak and valley in the market. Instead, he buys when the value is there. He holds for the long haul. Trying to time the market perfectly can lead to all kinds of stress and missed opportunities. Instead of trying to predict every twist and turn, focus on building a strong, balanced portfolio, one that you're comfortable holding through all kinds of market conditions. If you're in it for the long term, you're already ahead of the game. So, if we break it down, the real strategy here is pretty simple. Build your cash reserve, be patient, choose value over hype, and don't stress about trying to time every little move. Buffett's strategy might seem boring in the world of fast trades and trendy stocks, but his results speak for themselves. Want to know why Jamie Dimon thinks the market will melt up rather than crash down? Click the video on the screen to find out.